And now for something completely different.
It's a Rick Bass world.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And welcome to the show this morning. It is 6:07 as we get this hump day edition of the Real Investment Show underway. Of course, Danny Ratliff, certified financial planner, joining me this morning. We're talking about tax plans. Yesterday 50 Cent came out and said he's only going to be worth like 25 cents if Biden gets elected and, gets a 68% tax rate. So, of course, this is a guy that's already seen the inside of tax court. So there you go. Then there's that. So anyway, we'll talk about the Biden tax plan, the Trump tax plan, what that potentially means for you this morning with Danny. So also make sure that you get registered for this weekend's Policy Over Politics webinar we've got on Saturday. I'm going to join Danny and Richard Russo on Saturday to talk about what the election means for markets, what happens generally after elections, potentially a contested election. What does that mean? We'll go over that discussion this weekend. It's our live webinar. It's on Saturday from 8 to 9 a.m. You can register now at the website, realinvestmentadvice.com. Okay. More stimulus, no stimulus, where are we? That's the real question. Yesterday was the deadline. That Nancy Pelosi, she had drawn the red line, thrown down the gauntlet, and had pretty much said absolutely no stimulus deal is going to get done before the election. If we don't get a deal done by yesterday, we're still negotiating. Call yesterday was Steve Mnuchin, again, still trying to talk on the package. Again, hopeful headlines this morning that we're still working to get a stimulus deal put together. And this is a particular point, particularly as, unemployment checks have now not been going out. The extended benefit, regular unemployment benefits are going out, but not the extra $600 a week. Of course, $1,200 checks to households, that hasn't happened. And again, concerns are, of course, that people need money. Here's the one thing to think about, though. We did the original stimulus package. We did the extended unemployment benefits. We got a lift out of the economy, right? Now, everybody's concerned now that if we don't do another big stimulus package, that we're going to have another economic downturn. May be the case. But here's the one question that you should ask yourself. Okay, great. We do another stimulus package, right? We add another couple of $1 trillion to the deficit and the debt, and we'll deal with that later down the road somewhere. But the point becomes that what are you going to do next, right? What happens when this stimulus runs out, right? Because whatever you do, yes, you're going to get an economic lift, and as soon as you stop the stimulus, the economic lift is going to dissipate, and the economy is going to turn down again. So you have to do another stimulus package. The problem is you're getting yourself into this trap now that you can't get out of doing these stimulus packages, because every time we stop doing one, everybody starts screaming for more money, right? So the problem is that at some point, our congressional leaders are going to have to start to actually focus on the debts and the deficits. We're pushing $28 trillion in debt now. We have a debt ratio that is greater than our GDP ratio by a large amount at this point. And of course, we're running nearly a $5 trillion. If we do another $2 trillion, we'll be at a $5 trillion deficit by the end of the year. So, this is all problematic long-term for economic growth, of course, weaker wage growth, economic prosperity, wider wealth gaps, all those things that everybody's concerned about. This is what's exacerbating that problem, but yet we keep demanding more. And in fact, voters, there was a headline out this morning, voters are telling their senators that, hey, forget about doing anything else, just focus on the stimulus package. We don't care about anything else. Just focus on getting us more money, right? This is the demands that the populace has now figured out, that they can now vote themselves a paycheck from Washington. And this is also the decline of democracy typically throughout history, is when voters figure out they can vote themselves a paycheck, that's typically the end of your democratic and your move towards a socialistic type government. So, these are the things to think about. Okay, with that, though, the markets are, again, kind of trying to figure out what's going on with stimulus and wanting to do it. Yesterday, markets kind of back and forth all day long again. It was all on stimulus news. We had a strong open in the morning, kind of faded off in the afternoon as stimulus talks began to really kind of fail. This morning, stocks are still going to be trying to hover right around here, around the 50-day to 20-day moving average. Again, just trying to hold that support. Been consolidating here. We continue to work off the money flow sell signal. That's good news. But we are close to triggering a MACD sell signal here. So we've got a couple of things that are pressuring markets lower in the short term. Again, a failure to get stimulus is going to likely lead to a further decline in the market. So again, that's a real possibility here. Senate is pretty steadfast that they don't want to do a big $2 trillion package. They're looking to focus on something around $500 billion. That's going to be problematic. They may get that bill passed, but that won't pass the House. The House won't get their bill past the Senate. And in fact, Mitch McConnell is now talking to the White House, kind of asking President Trump not to support a big stimulus package right before the election, because it kind of undermines the fiscal conservative Republican kind of thesis that they are fiscally responsible in government to at least some degree. So again, at least they pretend to be. And so that's kind of the trade-off here at this point. So this is likely going to lead to no deal getting done here. This has kind of been the risk here over the last couple of weeks. That does put some more downside pressure in the market short term. So again, yesterday we started taking a little bit of profits. We're going to continue that process this week, just kind of lifting some profits out of portfolios, rebalancing risk in portfolios as well. But keep a watch on this right now, because again, a lack of stimulus with sell signals now in place does put some additional downside pressure in the markets. One other thing to watch here, of course, is the 10-year Treasury, because bonds have been breaking down here over the last couple of days. We did break back below the 200-day moving average yesterday. We'll see what happens today. But again, more issuance of debt is, and this is what kind of the bond market is trading on at the moment, is this expectation of another $2 trillion worth of stimulus hitting the market. The Federal Reserve is basically the only buyer of that debt right now. So interest rates are trying to come up here, but that's also going to start very quickly impacting the housing market. Mortgage applications already declined. The 30-year Treasury rate has been lifting up here over the last couple of weeks. Of course, that's lifting mortgage rates. So those historically low mortgage rates that were helping spark a housing boom is very quickly going to turn here as rates come up and mortgage rates begin to rise, and people go, well, hey, you know what? I missed it, and so I'm going to wait for rates to come back down again. So again, higher rates in the short term, bad for economic growth as well. So kind of keep a watch on both of those. Okay, come back after the break. I'm your host, Lance Roberts, with The Real Investment Show. We'll pick up with Danny Ratliff talking about the Biden-Trump tax plans and what that means for your money, and basically what does that mean for 50 Cent. So we'll come back and talk about that. Don't go away. I'm your host, Lance Roberts. Be right back.
Love isn't always undone.
Get daily investment news you can use, delivered at the speed of the internet. Sign up for the Real Investment Report now at realinvestmentadvice.com.
Who will win the election in November? How will that decision affect your decisions for your retirement? Richard Rosso and Danny Ratliff's next Candid Coffee can answer your questions about money, retirement, risk management, and how to identify and protect your household against financial vulnerability, regardless of who's elected. Send your questions and join this live go-to-webinar event at realinvestmentadvice.com. Candid Coffee with Ratliff and Rosso at realinvestmentadvice.com.
By the show this morning at 6:18. Danny Ratliff joining me this morning to talk about tax plans. Yeah, I know we're getting into that part of the election cycle where it's now debating the topics and whose plan is better than this plan and that plan and what does it all mean. And of course, taxes are the big concern. Of course, as we talked about yesterday, rapper Curtis 50 Cent Jackson. He's been in tax court before, but he's outraged by Joe Biden's 68% tax rate that would apply to people in like California, New Jersey, New York, etc. And again, we've already seen a big outflow of people from New York because of the whole coronavirus lockdown and kind of policies in New York. Anyway, people have been fleeing New York and stop coming to Austin. Find somewhere else to go. But yeah, we've had this big influx of people coming to Texas. Why? Because low tax rates, right? Friendly business environment, low tax rates, and there you go. So
Well, and I think he said he didn't want to become 20 cent.
Yeah, exactly.
So, well, and this is one of the big implications. I think that we're watching a lot that's going on, and I think people are a little bit fearful of what may occur. Now, we do have to keep in mind that in order for Joe Biden's plan, and this is what specifically we're talking about at the moment, because this is what 50 Cent was referring to, and in order for this to probably come to fruition, you're going to have to take not only the presidency, you're going to have to take the Senate as well. And also be mindful, this is a lot of election rhetoric. It's likely going to look much different from here, but there are some unintended consequences. He's talking about raising corporate tax rates. One of the big things of the plan is saying that it's only going to impact those who make over $400,000. And we find that that's very unlikely. The Tax Policy Center, there's many different tax foundations that are bipartisan that come out and they say, here's what the overall impact will be. So for those making over $400,000, they say, look, payroll tax is going to be, we're going to bring that back. Currently, that runs out at $137,700. So what that means, if you make a dollar over that, that dollar won't be taxed for your payroll taxes. So you get a nice little boost. For those of you that make more than that each year, you probably see that sometime during the year and you say, wow, this is pretty cool. Got a little bit of a pay raise. That may be going away if you make over $400,000. Now, also talking about raising those tax rates from 37 back to that 39.6. We're going to see more and more talk like that. One of the bigger things, Lance, I think that we need to be careful with, especially for those who, with larger estates, the estate tax that Biden has planned is really cumbersome. I mean, he's talking about getting away with a step up in basis. Currently, you have a step up where if somebody passes, you get that as your new cost basis. So if you have something that's worth, we'll just use $1 million for an easy round number, and you inherit it at $1 million, while your parents or whoever it may have been may have paid $500,000 for it. Well, if you sell it at $1 million, at $1.1 million, you don't have to pay any taxes on that initial $1 million. That's your new cost basis. Well, he's talking about bringing these numbers way down. And I think that's going to be something that we're going to see a lot more strategic planning for. This does not impact everybody, but currently you can shelter over $1 million, Lance. He's talking about bringing it down to 3.5. Now, those numbers can change, and I think that we just have to be careful here. So while we're saying that it's not going to have a big or broader impact, his main thing, if you look at any of the big headlines, it's only going to affect those under $400,000. But what if you raise corporate taxes? Where's that money going to go? Who does that impact the most? It's going to impact the employees. So those working, so you may say, well, this isn't going to impact me negatively, but maybe you make 50, maybe you make 60, 100, whatever it may be. At some point, as corporations, their margins are going to decrease because he's looking to put a bottom line in there. Because we all know a lot of corporations don't pay anything, all the subsidies they get. And so this is an area where, we're getting a ton of questions around right now. And so keep that in mind. Now, what Trump is proposing to do is, on the other side of the aisle, he's proposing on decreasing or getting rid of payroll taxes. Right now, there's a payroll tax holiday for those making less than $4,000 a month. This could be something that we continue to see further down the road. I don't like that aspect. I'll tell you that right now, because this is basically diluting the Social Security and Medicare trust, because that's where these payroll taxes go. So when we look at all the big picture here, while economically, probably short term, Lance, that's probably one of the quicker ways to put money into the economy and the markets. But long term, I think it's going to create other problems, and it's going to magnify them, and they're going to get here much quicker. So we have, really, it's an interesting dynamic. Typically, the economy is what leads the election. Taxes are obviously a very big topic at the moment, and we're going to be seeing a lot more of that. So we're going to get into a lot of detail on this, what the overall policies in general are going to be, and what those look like this weekend on our Candid Coffee. Lance, the chart master, will be joining Richard and I. So we're going to spend a lot of time on not only just this, but policies in general, what you can expect on both sides. I think that when we look at one thing that they can all agree on is infrastructure, right? That's a big one that seems to be that both sides are looking at.
Yeah, it's true. But the problem is that infrastructure, the way they look at it, is not the infrastructure the way that you think about it. And everybody's like all excited. It's like, oh, we're going to do big infrastructure projects. And typically we wind up building, bridges to nowhere. those type of things, which don't create long-term revenue streams. And what they do is they just add to the debt and the deficit and detract from economic growth. So yeah, you get a little short-term bump because you put some people to work building a bridge, but once the bridge is built, then there's no revenue coming from that. Infrastructure as designed and the way it was supposed to be done is that you build income producing projects, right? So you build a nuclear power plant, you build a dam that generates electricity, you build a riverway that like a lock system that transporters pay a toll to use, right, to move from one area to another. And that generates long-term revenue. So great, you spend $1 billion building something, but then over the next 50 years, it generates $5 billion in revenue. So it pays for itself and creates a return on that investment. That's called a productive investment. The problem is today is that we do stupid things like build, high-speed rails that don't ever get built. We spend billions on it. They never get built. They never get done. Or they're a money-losing project, which only adds to our debts and deficits and doesn't create returns. So yeah, it's great that we're all talking about, infrastructure plans. But if you looked at, Trump proposed an infrastructure plan right after he got into office, all those projects were failures. Every one of them would not generate a positive return. Sounded great on the surface. Thank God we never did any of those. Barack Obama proposed infrastructure when he was president, right? And those, thank goodness, none of those projects came to fruition because they were all failure projects. But that's the problem, is that if we're going to do infrastructure, it's got to be done the right way. And unfortunately, people running our government don't understand that process, right? They just build projects that go to their constituents that make them feel better, right?
It's like you said, on their jackets, they should have their sponsors.
Exactly.
But that's the problem with all these bills, talking about that infrastructure aspect, it's not that it's actually materially changing the infrastructure of the country. And that's something that we're failing drastically at and falling way behind.
Right.
And so what's the answer on that?
Well, no, look, if you want to rebuild the power grid, that's something that desperately needs to be done, right? So, and that's something that when you rebuild a power grid, what does everybody pay for? Everybody pays for electricity, right?
Yeah.
So when you use the power grid, you pay a fee for using it.
You get a revenue.
That's a productive investment. I'm all for that one, right? So mark me down for rebuilding the power grid. That'd be awesome. Stick a few nuclear power plants on there. We're good, right?
Yeah.
Now we can go on and generate some, actual productive amounts of electricity. So those are the type of things that we've got to focus on. And again, infrastructure is a good idea. You want to throw $1 trillion at it? Great. But do $1 trillion worth of infrastructure that's going to generate $5 trillion over the next 40 years, right? That's how you make this stuff work.
Well, and that's the problem, is that we're not looking at anything like that.
No.
nor will we likely.
No, we're going to spend $1 trillion, building solar power plants that take 100 years to pay for themselves. That's not a productive investment, right?
Well, and if you're here in Houston, you'll just continue to repair the same road over and over and over and over
filling
again.
Potholes.
Yeah. Well, we can't get there yet. There's too much more. There's too much else to do. So, but lots to talk about when we talk about these different plans, different agendas and ideas. And so I know we're coming up, 2 weeks out from the election. So
less
hot topic at the moment. And less. Yeah, what are we, 12, 13 days?
Yep.
Yeah.
It can't be soon enough. I just want to get it over with.
But you know what's going to happen. You're going to have the contested election. It's going to be dragging.
Don't even bring that up. We're not going to have a
on.
contested election. It's going to be just fine. It's all going to be done. Ballots will get counted. Look, I don't even want to talk about a contested election.
I hope and pray you're right, because I'm tired of hearing this junk.
I just don't want to have to deal with 2 more months of waiting for the Supreme Court to rule on something. So
yeah, that's very true. Well, it'd be nice to know.
That's not good for markets.
Well, and the other aspect as well, from the planning side, we'd like to get a little bit better perspective on what we have to deal with moving forward over the next several years, because like the pendulum swings from one side to the other. There's going to be some adjustments that need to be made.
Well, look, and again, one thing you said earlier is that what a lot of these proposals are right now, they're never going to come to fruition, even if there's a blue wave, right? And the Democrats take control of the House, the Senate, and the presidency. Still doesn't mean that you're going to get a lot of these things passed, because there's still a lot of moderate Democrats. They're not all, super left wing, green energy people, right? They're not all like that. There's still a lot of people, they have to go home and answer to their state. And when their state says, no, we don't want higher taxes, we don't want these type of things, there's still going to be a lot of senators that, balk against these more extreme ideas on any agenda platform, right or left, right? I mean, there's still going to be that give and take. So again, most of these things that you hear during the presidential campaign, most of those actually never come to fruition. And if you just go back and look at any presidency going back, even with President Obama, the majority of those ideas that he talked about on the campaign trail actually never came to pass. But that's just, functionally, hopefully, that's how our government's supposed to work, right? We kind of keep things moderate. We'll see. But anyway, come back after the break. We'll pick up on some more topics here. Got to talk a little bit about where the markets are headed right now, and of course, what else happens after the election. We'll get into that. Also, don't go away. I'm your host, Lance Roberts. Danny Ratliff this morning. Be right back.
Places where all the mates meet, yeah.
Got questions for Lance later? Ask now at realinvestmentadvice.com.
Who will win the election in November? How will that decision affect your decisions for your retirement? Richard Rosso and Danny Ratliff's next Candid Coffee can answer your questions about money, retirement, risk management, and how to identify and protect your household against financial vulnerability, regardless of who's elected. Send your questions and join this live go-to-webinar event at realinvestmentadvice.com. Candid Coffee with Ratliff and Rosso at realinvestmentadvice.com.
Everybody get up!
At 6:34 this morning, I'm your host, Lance Roberts. And, of course, we're right here in the midst of earnings season. Of course, Verizon announcing earnings this morning. They're beating estimates. NASDAQ were beating estimates this morning, not surprising with all the trading that's been going on this year. Their earnings were going to be good. Netflix, surprisingly, though, came in a little bit light on subscriber growth. Stock's going to be down this morning. Missed their estimates just a bit. But, kind of interesting just because, this whole, this is one of the questions we've been asking here for a while is that, Zoom's another good example of this. Here's a company that was, basically kind of a startup company, give or take, but really they became a Verb with the onset of COVID, right? We're going to have a Zoom meeting. Now, it's like saying we're going to go have a Coke, right? Could be Pepsi, Dr. Pepper, whatever. Zoom could be Zoom, GoToMeeting, Microsoft Teams. We just all kind of nickname it Zoom now. So Zoom's a Verb. But stock's been, growing tremendously, right? It was $100 back in April. It's $500 now. So, very sharp increase in price. Question is going to be, and this is the problem for Netflix as well. The question is now that everybody's been locked up, everybody's subscribed to their services, whatever, where's your growth going to come from, right? There's only so many people on the planet that are going to do Zoom meetings, right? And so the question becomes, where's your next, round of growth come from? Because once you've kind of absorbed all of your base, right? And there's other competitors, right? There's GoTo, there's Microsoft Teams, there's other people kind of invading that space. There's other online video services that people use. So the question is now going to become, and the same thing for Netflix, right? Once everybody's been locked up for months now and have watched everything there is to watch on Netflix, where's your new subscribers going to come from, right? This is going to be one of the big issues. What are you going to do next to attract more subscribers? So for a lot of these these work-at-home plays, there's a question now that's going to be, where does the growth come from next? Right? Well, because once you've locked everybody up and once you've done this, where's your growth going to come from? So again, we're going to kind of watch that and see, over the course of the next couple of weeks as these companies all begin to report earnings. That's going to be important. Companies like Clorox, we own Clorox as one of our holdings, they just sell products that people are using to clean everything, right? So their sales growth is going to continue because people have to keep buying that product over and over again. Once I subscribe to a service, I just pay a flat rate, right? So, if I've got to keep buying a product over and over again, that's a different story. but subscriber services are something a little bit different.
Well, and opening the economy back up, those are two different stories too.
Right.
Because as companies and businesses open back up, they're going to be cleaning more, and people may be watching a little bit less Netflix if they're not working from home.
Right.
But yeah, so it is an interesting story on how there's two different dynamics or shifts that are happening and occurring right now. But I think you're right. I read something that I think that Netflix said that if they had 48 more hours, they would actually beat their estimates, and they would have shown subscribership would have grown, much more. So it's kind of interesting,
right?
To think about.
It's all about timing when things happen. But it is interesting talking about Netflix, right? Because once you watch kind of all the new stuff, you start trying to find old stuff to watch. My daughter is in the middle; she's 16, right? And I don't think she was alive when Grey's Anatomy was running, right?
Yeah.
But she's in the midst of a binge watch of Grey's Anatomy, and she came down in tears the other day because one of their favorite characters died whatever. So, but yeah, it's interesting now. People are going back to watch really old series now. I just don't want something to watch. Give me something to watch.
Yeah, we don't watch a lot of TV, so I mean, it's not a big problem at our house. But yeah.
So anyway, all right. So talking about the markets here. So as we get ready to head into the election, look, markets have really just been betting over the last couple of days about stimulus. Take a look at the market yesterday. About 11 o'clock in the morning, there was some news that there was talk about a stimulus package, and Nancy Pelosi was talking to Steve Mnuchin over at the Treasury, and the market rallied. We had a big rally in the markets. About 2 o'clock, it came out that the talks really hadn't gone anywhere, and the market sold off. So this has really been kind of the spate of the economy and the markets over the last couple of days, is just living from stimulus talk to stimulus talk. It almost reminds me of when we were back on trade talks back a couple of years ago. Every day is trade talk headline. Oh, we're having a trade deal. And then some market would run up, and then by the end of the day, oh, no trade deal. The market would sell off again. But that's where the markets are right now, just kind of living from one headline to the next. That's unfortunate because it's not really a function of fundamentals. One of the interesting headlines yesterday was Google. The Department of Justice is now going after Google for antitrust violations. Now, it's been 2 decades since our last big antitrust violation. It's been 3 decades since the one before that. The one before that was when we broke up Southwestern Bell AT&T, right? And then the last kind of antitrust violation was against Microsoft. And it's interesting because the Department of Justice comes out yesterday and says, yeah, we're going to go after Google for antitrust violation. The stock was up about 2% yesterday. So I was like, yeah, whatever. Yeah, come at me, bro.
It's amazing the stories that are out there and the things that just the market overlooks, or it's all of a sudden it's a big deal. Like even talking about stimulus. A month ago, stimulus didn't matter. Everybody was just kind of like, we're not going to get it done before the election.
Right.
And now that we're in the midst of earnings, you would think that earnings would matter more, but no, it's
stimulus.
Yeah.
But it's interesting enough, talking about Microsoft. Microsoft actually did settle on the antitrust suit, and 2 decades later, its stock's at a record high. So I'm not sure that from a company perspective that these things actually matter long term, because generally companies spin off something to satisfy the antitrust violation. So they'll spin off a division of their company, and everybody says, okay, they're good now. Then they just go back and dominate the entire market and whatever they're in, and then they wind up buying that other division back at some point down the road. Kind of like the phone business. After we broke up the Bells, they've all now reaccumulated. So there you go. Anyway, all right. One other thing here is just before we get to the break is just really kind of paying attention to what's going on. Danny and I were just talking a little bit about this, kind of off air, is that in order to do these stimulus packages, right, it requires a lot more Treasury issuance. And the problem right now is there's no other buyers for Treasuries really other than the Federal Reserve. So now the Federal Reserve hasn't been really buying a whole lot lately because there hasn't been debt issuance for them to buy. And they are worried about taking over too much of the bond market. This is the problem with Japan. Japan owns about 80% of the corporate bond market. And so it's distorted the issuance of corporate bonds because there's only one buyer. So the interest rates don't reflect the underlying risk of the market itself. And this is the potential problem the Fed's going to run into, is as they absorb more and more of the bond market, because they're the only buyer for the bonds, in order to buy those bonds, leverage them, and then to do these stimulus programs, QE, PPP, all these other things, they run the risk of starting to distort the functioning of the bond market. So there is a point, while the Fed says they have unlimited potential, they really don't. Because once they begin to distort the bond market, the Fed's going to be very reticent about doing more and more QE and distorting the bond market further. That's one reason they haven't been buying a lot of corporate bonds as of late. They delved into that market temporarily, but they very quickly ran into the problem. They were distorting bond prices, so they stopped doing that. That's going to be the same problem ultimately with the Treasury market, because that does have impacts down the road in terms of measures of inflation, economic growth, those type of things. When you distort interest rates, it has a big, broad effect on the overall economy. So just keep a watch on that. That's going to be one of the things coming up, is really how the Fed handles more stimulus at this point and more debt issuance.
But this is interesting because this is one thing that I think most people are tuned into because they own bonds right now. Mm-hmm. We're seeing rates climb, so obviously their asset values dipping a bit. But longer term, we still believe rates are going to remain low.
Yeah, they can't go up much. We talked about this yesterday. If you take a look at the history, and I've got a chart on this coming out next week. If you take a look at credit market debt, right, total credit, consumer credit, right, and you just assume that all consumer credit is tied to the 10-year Treasury rate, which it isn't. But if you just assume that, every time that rates rise by just a little bit, you have either a recession or a credit crisis in the market. And just think about what's happening now. Rates were exceedingly low in the mortgage market. And we saw a whole bunch of people run out to get mortgages, refinance houses. Well, just over the last couple of weeks, rates have come up here a bit, and mortgage rates have declined. Mortgage applications declined by almost a full percentage just in a week. So buyers are very, very sensitive to credit rates when they are heavily leveraged, and particularly in the housing market where you've got high prices and low rates. When those things converge, you typically wind up with a not so good outcome for housing market, which next year, that's a real risk for the whole real estate market, that you could see a fairly major decoupling of the housing market next year. Quick break. We'll come back, wrap up the show, talk about other stuff that's going on. Don't go away.
Showing out what keeps strong is your fight. It doesn't matter who's wrong or right, just be there.
Real Investment Show podcasts are now available on iTunes. Listen anyplace, anytime at iTunes.com.
Who will win the election in November? How will that decision affect your decisions for your retirement? Richard Rosso and Danny Ratliff's next Candid Coffee can answer your questions about money, retirement, risk management, and how to identify and protect your household against financial vulnerability, regardless of who's elected. Send your questions and join this live GoToWebinar event at realinvestmentadvice.com. Candid Coffee with Ratliff and Rosso at realinvestmentadvice.com.
Come and shake your body, baby, do the conga. No, you can't control yourself any longer. Come and shake your body, baby, do the conga. No, you can't control yourself any longer.
And welcome back to the show this morning. I'm Rose Lance Roberts. Danny Ratliff joining me this morning. So, interesting question. Carl P. on our YouTube channel asked a question. He says, do you think there's a chance to repay back the debt if the only source of government income is stimulus? Okay, well, so first of all, government income doesn't come from stimulus. Government income comes from taxes. Okay, so, but it's an interesting question, because if we dissect that just a bit, right now a lot of people are getting stimulus, right? So when we do expanded unemployment benefits, if we do household, another $1,200 to a household. Let's take this further, right? Let's say that we're going to start doing $1,200 a month or say, let's just round it up, $2,000 a month. Every month, households are going to get a check for $2,000 a month. This is called universal basic income, right? Everybody gets $2,000 to live on, and that covers their basic essentials, and then they can go out and work and create some more money, right? Well, so all that government payment is basically tax credits, so they're not taxable. So there's no income from that. So I can't pay debt on stuff I'm not collecting income from. So, but here's the bigger problem. right now, the revenue that we collect from taxes, it requires roughly about 120% of that revenue just to pay mandatory benefits. What are mandatory benefits? Mandatory benefits are Social Security, welfare, Medicaid, prescription drug benefits, and interest on the debt. That interest on the debt is going up, even though rates are low. We're so rapidly increasing the amount of debt that we have, the amount of debt service is rising. So it now consumes more than all the tax revenue we collect just to pay the mandatory. So anything else that we spend money on, defense spending, education, healthcare, all that other stuff, right, is all done out of debt. So as we increase more debt, that's more interest service on the debt we've got to pay, which detracts more of our tax revenue base. We're giving out more money for stimulus, so to speak. Well, that deters people from working, right? And, the more that you do in terms of social benefits and social stimulus, et cetera, the less productivity you have within the economy. I mean, if I'm making enough to sit home and play video games all day, why am I going to work and not pay taxes, right? I mean, it doesn't take people long to get to that conclusion. Now, there's a few people like, Danny. He's like all, financially responsible and stuff, and he wants to, be successful and grow his business and make more money and support his family. No, he's that guy, right? So he'll pay taxes for now until he realizes that he's the only guy paying taxes and nobody else is. And this is the problem. Eventually the taxpayers go, why am I doing this? Why am I paying all these taxes to support all these people who aren't paying taxes and are just living off the government dole? So what happens is that people stop working as much, right? They go, why do it? This is the same, analysis that we've done before talking about a school, right? A professor has a class, and so he gives a test to all the students in the class. And, as with all classes, there's that group of students like Danny, they go study all night, pull the all-nighter at Denny's, study, makes an A on the exam. Then there's the other group of kids like Brent that just go out and party all night, make a D on the test, but they're okay with that because, they don't really care about college anyway. They're just there for the party. And so then the next day, the professor comes in and says, hey, you know what we're doing? We're just going to socialize the grades. We're going to average them all, and everybody gets the same grade. So everybody gets a B. Well, next time the test comes up, Danny's going to go, why am I going to study all night? I'm going to go out and party because, they're just going to average the grades anyway. So now the average grade's a C for everybody because productivity declined because nobody went, Danny didn't go do his job of studying and bringing up the curve, right? This is the problem ultimately with socialism. And we're rapidly heading down that rabbit hole of a dependency on debt to fund socialistic ideas that reduces economic prosperity and productivity in the economy over time. So the answer to your question, Carl, is no. You won't ever repay the debt because it requires more and more debt to keep doing more and more of these actions. And so ultimately you get lower rates of economic growth, you get wider disparity between wealth, and you wind up with, instead of the top 10% of the income earners now owning 90% of the stock market, it'll be the top 5% of income earners that have all their money offshore that own 95% of the stock market. And that will be ultimately how the end game works. And that's the way it is in France. I used to work there for years, managing money for high net worth individuals. And where was all their net worth? Because they have an 80% tax rate, it was offshore. It was not in France. They didn't bring the money back into France to pay an 80% tax rate because they didn't want to support the socialist system. That's the way it works. Those with means and opportunity will move their money to where it has the least negative impact from government overreach and taxation. That is the basic premise of wealth, right? And as soon as you figure that out, you will then start to figure out why we're heading down a rabbit hole that you don't want to go down. So there we go. Anyway, thanks for the email, Carl. Good question, though.
That is a great question. I think that, understanding where funds come from, how they work overall, is probably one of the things that's overlooked or just not taught because there's so many moving parts I mean, even a lot of advisors in the industry, I think, have a hard time fathoming, the whole economics behind what's actually going on.
Right.
And I think that's one of the bigger things. So questions are great. Please keep them coming. We love it. We love answering them anytime.
Yeah.
Especially
And
Lance. Lance loves it.
I love questions. And it makes for good articles down the road somewhere. So.
Yeah.
So, but no, it's just it's simply the function. And look, this isn't rocket science. I had a phone call from a congressional representative, remain nameless, but talking about the idea. They're putting together a panel for sound money, right? They want to have sound money back in the United States. Now, what is sound money? Sound money is theoretically a currency backed by some form of collateral. And this was the problem that occurred back in 1971 when Richard Nixon took us off the gold standard. No other country at that point was really on a gold standard, but the U.S. still was. And so everybody was holding U.S. dollars because we were sound money. We were backed by a commodity, right? So other foreign countries were holding our currency as reserves because of the stability and the safety of that currency. Well, in order to expand spending and doing all these other things, we couldn't maintain the peg to gold, so we had to come off that. So we became a fiat currency, backed by nothing. That's what that means. Well, since then, in order to maintain the reserve currency status, we have to run a trade deficit with every other country in the world. And that's why our trade deficit continues to grow, because as long as we run a trade deficit, everything's okay. As soon as we ever run a trade surplus, and this was one of the mistakes that Trump was running down earlier with his idea that, we have a big trade deficit with China. We want a trade deficit with China. We don't want a trade surplus with China. It's not good for us because of the de facto reserve currency relationship that we have with other countries in the world. We have to run that trade deficit because we are the reserve currency and we're a fiat currency. Now, if we ever go back to being on a gold standard, different story. We can run a surplus. That's fine. But because we're now all on a fiat currency basis, it's really just the guess of which currency that everybody wants to hide in temporarily. And this becomes problematic when we start doing things that ultimately lead to concerns about our fiscal stability long term and our ability to repay our debt. When we get to the point that our other trading partners go, you know what? I'm not so sure with the U.S. now at $40 trillion in debt that they're able to actually pay that debt down the road. And all of a sudden other currencies start going, I think I'm going to hide my money somewhere else. And they find other countries in order to deposit their reserves in that might be deemed to be more stable. That's the end game ultimately for the U.S. As long as we're the reserve currency and people are willing to buy our debt and hold our debt and store their reserves with us, we're okay. It's when they ever determine that that is not the safe place to be that it becomes a real problem. Now you're talking about sharply rising interest rates, rapidly rising inflationary pressures because of a collapsing dollar. That's not where you want to get to.
No, and how far off are we from something like that?
Who knows?
Yeah.
There's no way to know.
Because that is a common question that we do receive is that, okay, I mean, we are the best house in a bad neighborhood.
Right.
So who else steps up and who do they put their trust in?
Yeah, you don't know.
Yeah.
It could happen tomorrow. It could happen 100 years from now. That's the problem. I mean, look, Japan's at 280% of debt to GDP. So far, other than having no economic growth in 30 years, people are still, doing business with Japan at this point. They're paying the consequence. It's like boiling a frog in water. They're paying the consequence for their actions. But at this point, that bug hasn't hit the windshield yet. And the question is always from one year to the next, is this going to be the year that it happens? You never know when it's going to happen, and it can be much further out. We may all be dead before it happens.
Yeah, that's true.
But, it's the other problem, though, is that it could happen when you least expect it. And that becomes the problem, is that you don't know what triggers that loss of confidence.
Well, that's going to take all the sovereign banks coming together and basically saying, hey, we're no longer going to do business with the U.S., correct?
Well, we've had banks talk about that. China's talked about creating a reserve currency. We've got SDRs that are now floating around, out there. So there's been action. This is not like everybody's sitting around going,
yeah, we're not worried about it, we're not doing anything. There's been action taken to start setting up other alternatives to the U.S. dollar. Those haven't taken hold yet. But the point is that people are aware, and other governments are taking action to start diversifying their risk out of U.S. dollars. And again, how does risk happen? Slowly at first, then all at once. And that's the way this happens. Slowly at first, and then all at once. But again, it could be decades before that happens. It's just the problem is that we're making choices, more debts, more deficits, doing these type of actions that are pushing us down that pathway further and further. And again, we've got government officials wanting to talk about sound money, but they have no idea
what it is.
They have no idea how to even get back to that, because they're not willing to give up the debts and the deficits and being able to spend money on anything they want to go back to being fiscally conservative and moving back towards a sound money policy. Can't have your cake and eat it too. All right, wraps up the show for today. Danny, thank you so much. Get by the website, realinvestmentadvice.com. Get signed up for our upcoming webinar this Saturday. It's on policies versus politics. We're going to be talking about policies, the markets, taxation, all those type of things. Danny, Richard, myself will all be doing it this Saturday at 8 o'clock. Register the website now, realinvestmentadvice.com. Have a great day. We'll see you tomorrow. Stick around, though. Chris Salcedo's coming right up.